Have you ever thought, well, how can I not underperform in the stock market, but also be able to take bets where I've got the upside there? I mean, one thing for me has always been, well, what if this idea doesn't work? Then have I just wasted a lot of time? Would I have just been better off putting it in the S&P 500? And a good concept that I've sort of come across recently is to sort of protect myself from this and actually be able to have that upside, but but make sure that I'm still outperforming the S&P, is by this concept of being paid to wait. And this is an idea I really like, because what it means is that if you're able to find a business which is stable, has quality earnings which you think is going to maintain and continue, then what actually can happen is that you have a business which is going to maintain its earnings and its quality, and it's going to continue growing ideally, but equally it has a very high dividend yield, which means that you will be able to effectively make your 7 to 8% returns that the S&P 500 has historically generated in the form of dividends through the company you own. And that way, that will guarantee you some sort of return, whilst you have upside for the actual business itself to continue growing, to revalue into what you think is a fair price should be according to your thesis. And now it's going to be harder to find these type of companies in America, just because the average price earnings in America is like 20% a year, 20 times earnings. But if you're able to find these type of businesses in more stable countries, where the currency is just as stable, almost as stable, then I think I could do really well here. And a couple of good examples of countries that I think could really fit this criteria is the likes of the UK. They have, big fans of dividends here, and as well as Poland. Actually, Poland is an up and coming country. It's been growing quite significantly over the last few years. I mean, if you looked at there have been multiple multi-baggers in Poland. If you've had any sort of look into the market over the last few years in particular, and by doing this, obviously, to get a 7 to 8% dividend yield, that would imply that if the company is paying out all of its net income, then they would need at least a price earnings of 11, 12, which is quite low considering the S&P 500 is trading at 20 times price earnings, 22 or whatever it is in the minute. So it'd have to be quite low, and realistically, that company again is probably going to set aside a fair bit of money for paying off its debt, cleaning up its balance sheet, for just reinvesting into growth and so forth, right? And just to build up a buffer. So realistically, the type of companies you're looking at will more than likely have a price earnings ratio of 6, 7, 8 times and below, so that it can afford a 7 to 8% dividend yield that you're looking for. These type of companies, again, it only work if it's in a stable currency environment. So I wouldn't necessarily be pinning my bets on this in like the likes of Argentina, or currencies which have had significant currency collapse. Um, I can give you an example. For example, in Poland, for example, there's a company in the name of XTB. I think they're trading at like 11 times earnings off the top of my head. They have a 6% dividend yield. Yes, slightly lower than what we're looking for here if you are after the 7, 8%, but the company's growing at 20% a year, which is insane growth, right? The balance sheet's in an okay position. Yes, the earnings are cyclical, but you also have the fact that the business is poised to sort of grow outside of just its main market, Poland. It's expanding into more its presence into other European countries, and that growth is going to likely maintain. And obviously, as the business grows, the dividend will also follow. And just because it's such a low price earnings ratio, you could argue that it's significantly undervalued and could be worth a lot more in the future. Again, Poland's relatively stable currency. It's been a fast-growing sort of economy and quite desirable to get into. So from that perspective, you could see that to be a good opportunity. Another one that I've sort of previously have looked at is the likes of First Pacific. Now, whilst this company is based in Hong Kong, which is again, they love their dividends, they're tax-free in that region as well, so it makes it particularly attractive. Whilst the currency has been less stable, there is some true. The business in this particular instance, when I looked at it, was trading at a price earnings ratio of 3.6 times earnings, or forward price earnings. The business had, I think, a 8 to 10% dividend yield, so very well compensated there, even if some of that went away because of devaluation. And what that meant is that actually you have a business which is worth trading at 3.6 times earnings in the future, has a 7 to 10% growth rate that it can continue through its investments across Asia. Again, having studied this management team, I think they're quite sharp in terms of the acquisitions they made and so forth. They're quite diversified across Asia itself, a few different countries. And what that means is that you have a business that's at 3.6 times earnings in the future. It has a 8% dividend yield, so it's going to protect you from sort of any underperformance. Yes, there is a bit of currency exposure, but because the business is so significantly undervalued, you have the opportunity to watch this business appreciate into a 10, 11, 12 times earnings multiple, which is, I think, was realistic at the time. Plus the fact that it's continually growing, and lo and behold, actually, it's paid out its dividends every year pretty much, whilst being able to compound the stock actually at like a 30%, 20-30% rate over the last 2-3 years. So you would have done quite well there. Now, obviously, it's just two examples there, but that's generally sort of the things I'm looking for. That's like a blueprint, a framework that I'm looking for. If you've got any sort of ideas, let me know. I'd be glad to have a sort of look and see for myself. Thanks for listening.